Hi, it's Dale again from the Investment Journey. Today I'm going to be investigating Caterpillar Inc. and we're looking at the intrinsic valuation. I'm going to be looking at relative valuation, using the CAPE ratio and explaining why I think this is the wrong time to be buying Caterpillar. If you like the video, please subscribe and like and comment. It really helps with the algorithm. Okay, so we're going to do a quick business review, a very short recap. We're going to be deep diving into the business cycle and we're looking particularly at the CAPE ratio. What is the CAPE ratio? It's cyclically adjusted PE ratio, which gives you a better impression of how a company looks over the entire business cycle, which is particularly important to cyclical companies like Caterpillar. And I'll explain why I can't buy this stock at the moment. It needs to be coming down to about $60, $70 for my margin of safety. Caterpillar are really famous for the wide range of industrial machinery that they provide. You see them a lot in construction environments, used in large-scale mining operations, in energy, oil and gas, lots of different applications for these different vehicles. They also do some power systems and a lot of aftercare stuff like spare parts and attachments for all these vehicles. They've also kind of been digitalizing their fleet. They now have quite a wide range of semi-autonomous and autonomous driving vehicles or adjustments that you can make to existing vehicles, as well as some fleet performance and some measurement sensors which help with optimizing the fleet for professional customers and clients. So when we look at the business, they have their business structured into three business segments: construction industries, resource industries, which is mining, energy and transportation. So we need to look at where are all three of these markets within their own cycle. How do they correlate with each other, and what does the combined effect have on the total company? Let's look at the construction industry first. So we can see a decline in sales, in profit from 2018 down through to 2019. And if we look at that as a trend, and we look on the right hand side graph, the red bar, which is 2011 to today, it has been rising steadily, but it's been plateauing. And now between 18 and 19, we can see that it's likely to be dipping. And with the coronavirus, we expect that that'll dip more dramatically and sooner than probably anticipated. So I think it's fair to say that if we're looking at today's results, it would be basically already at its peak. So if you're valuing the company based on these sales and this profit, is it sustainable in the future? I think this is going to be probably the best case scenario, and the likelihood is that the downside risk is bigger than the potential for any further growth here at the moment. Moving on to energy and transportation, I think we all know that the oil and gas in particular has been taking a really tough time over a few years due to low oil prices, and I think that's borne out with the graph on the right hand side, where we can see a cyclical decline ongoing. But the reality is, at a certain point it's going to bottom and we're going to see growth again in this area. So this potentially might be a good entry point. However, I think the challenge that we've got here is the impact of the coronavirus is killing demand for oil and for other resources and other energy, and therefore it's hard to understand how long it's going to take for that industry to recover. And for sure, things that people are going to cut back on is capex investment, and I think that the products that Caterpillar sell are really fall into the bucket of cost. If I was an energy company and I was losing money at the moment, I would be reducing my capex and I would be sweating my existing assets for a longer time period before I upgrade. I might do some overhaul of existing stuff, but I'm not going to be investing in vast amounts of new product. And then finally, we've got the resource industry. So effectively, we can see yet again another dip in sales, another dip in profit, and the margins are really under pressure in this area. And the reality, if we look at the super cycles and the commodity, is we're probably beyond the peak now. And again, there's a risk of a falling growth in the resource industry. This cycle could happen, but there is also a potential upside here that due to all the quantitative easing that's come in, an inflationary environment is normally good for the profitability of resource companies, and the cost per item of resource you're extracting goes up, and therefore those companies tend to become more profitable in that type of environment, which could be helpful to the sales of Caterpillar products in that area. But as we've seen with all three of the cycles, huge level of uncertainty, and 2 out of the 3 are potentially in a declining environment, and the third, energy, has some risk to how low that and how flat that bottom's going to be. Is it going to be V-shaped, or is it going to be U-shaped in terms of the trough? So that's why my initial instinct is that this is the wrong time to be looking at Caterpillar. Looking at the overall business for Caterpillar, I've taken these results from their own published statistics, and we can see here how the total amount of retail sales has been trending down in all the key markets. If we look at North America, it's up. In the world, it's been up all the way back from January last year, but we can see slowly 9%, 7%, 6%, 4%, 3%, and then down. So the trend in terms of the sales within Caterpillar was negative, and this is before the impact of the coronavirus. And one can only imagine how bad the March and April results are going to be compared to these ones that have already been published. So a negative trend on top of a deep dive into the 3 different business segments leaves me to question where we go with this company. And I must state here that I think the product of Caterpillar is outstanding, and it's a market leader in terms of the products it provides, and it clearly has a moat in terms of its brand quality, in terms of how profitable it's been compared to its peers, but within that industry. But there is still a huge amount of risk at the moment within this stock. So let's look at the CAPE ratio, otherwise known as the Shiller PE. So this is analysis over 10 years and cyclically adjusting all the earnings. Thanks to our friends at Guru Focus taking some of their data, we can look at it. So we can see here that the Shiller PE can get down to just under 10, 9.48. It's been up at a maximum of 35. So currently it's at 17.84, which is very close to the median. So one could argue that it's fairly priced, but in a relatively low growth company, do we want to be buying at fair price, or can we do better than that? And I think we can do better than that if we wait and we time it. And I think it's not unreasonable to expect that we can purchase this stock closer to the minimum Shiller PE, a target of around 10. And then if we look at the competitive comparison, we can see the Shiller PE for Caterpillar is one of the highest of its peers, and probably it should be, because we can also see by the size of the circle that it's one of the biggest revenue companies within this sector. But again, this gives me a further evidence that there's a better time to be purchasing into this stock. And the good thing to say about this stock is it's dividend aristocrat. So 25 years of increasing the dividend year on year, which is fantastic. But that doesn't mean to say that we're just buying for the dividend. That is just not yielding enough to justify it alone. We need price appreciation, and for that we need to buy at the right entry point. So what the challenges I've got here with Caterpillar: the first one's very high level of debt. Positively, the cost of debt is very low, which is good in the short term, and it allows them to have this high level of debt. But with record low interest rates, if you're already taking all of your loans out at 1-2%, how much better can you actually do? So I don't see any upside in improving the cost of debt within Caterpillar, but what I can see is if interest rates rise, then it's going to be quite painful. They have done a good job of quite a lot of it as long-term debt with different maturity dates, so that's positive. But in an inflationary environment, it could still become a greater burden to the company. Secondly, Caterpillar act as a loan provider to a lot of customers, and the exposure that brings to Caterpillar means that in a depressionary environment like we've got with the coronavirus, we could see customers defaulting on their debt obligations towards Caterpillar. And it doesn't really matter if you're A-rated creditworthiness. If your customers are not and they become insolvent, that is going to have a negative impact on your cash flow and your ability to make profit. So that's something that I'm going to be watching really carefully. And the final one that we've discussed a lot already is cycle timing. So let's just do a little bit of evaluation using some different scenarios. So first one I'm going to use the CAPE ratio. It's just a really simple calculation. I've made an inflationary adjusted earnings per share and created an average earnings per share, cyclically adjusted, and then multiplying that by the current CAPE ratio, as we saw from the slides with the Guru Focus data, we'd get a target stock price of $109, which is actually still slightly less than what the stock is currently trading at. But then if we really want to get to a CAPE ratio of 10, which we think we can do, or I think I can do, given where we are and what we've seen historically is possible, then we should be looking to try and purchase a stock around $61. That's obviously, nearly half or more than half what it's currently trading at. So I'm not really sure whether that is scientific enough, so I took another view. Moving on to discounted cash flow analysis. I actually did this before I did the CAPE ratio, just to avoid any bias that might be created by my own understanding of the valuation via the CAPE. I did a discounted cash flow analysis with a required rate of return to me, which is 10%. It's typically what I use for mature blue chip companies, with a margin of safety of 30% discount. If it's very high risk, smaller cap companies, then I might use margin of safety of 50%, but for here it's 30%. I have made some adjustments for future earnings based on the cyclicity of the business, and I've also impacted the next 2 years to take into account the negative impact of the coronavirus on the 2020 results and also on 2021 results. What I've discovered from that is a fair valuation to me of about $83 per share, which is considerably less than the current stock price. And that's just fair value. If I want to get a margin of safety which protects me from my own errors in calculation, also gives me some confidence that the uncertainty in the market, the uncertainty in the different business segments that we've got around Caterpillar, that I won't be caught out purchasing the share price. Then applying that, I need to be aiming to buy around $60, which does correlate with the CAPE ratio valuation quite nicely. The actual margin of safety valuation is $58. I think, hand on heart, taking into account the very solid dividend that's been going for 25 years as a dividend aristocrat, I think I would start looking very carefully at this stock again and maybe doing more analysis if it started to drop around $70, so it's below the 83 considerably. Before it touches a 58, I'd start to get excited and want to take another deep dive into it, but for now it's not really a buy for me. Great company, it's got a high degree of excellence within the company. You know, it's definitely got a moat. It's the number one company in most of the market segments it operates in. It's got higher margins than most of its competitors. It's been around for a long time, and for a cyclical company, it's stable within the relativity of being cyclical. But it's still not a buy. And despite me very much wanting to purchase this stock, it was something I was looking to put into my ISA. It doesn't feel right to me at the moment. I'm just going to sit on the fence and wait. Thanks again for sticking with me to the end of the video. It's been a real pleasure for you to spend some of your precious time listening to this analysis. If you enjoyed it, please like, comment and subscribe. Thanks very much. And this is just a disclaimer. This isn't investment advice. Take responsibility for your own actions. Seek professional investment advice if you need to. And I'm just sharing this for entertainment and informational purposes only. This is my own personal view, and I'm responsible for my own actions, and you are too. Thanks a lot. Bye.